Hi guys, my name is Harris and I'm an investment associate and CFA charter holder, and in today's video I'm going to take you inside the world of investment banking. So I work in leveraged finance where I help private equity firms and companies looking to buy other companies fund this through debt financing. I'll go into that in more detail later in the video alongside what my day-to-day looks like, but first let's zoom out and understand what the banking landscape looks like. So there are different types of banks, and let's start with retail banks. So they serve the general population, i.e. you and I, and provide current accounts, saving accounts, credit cards, personal loans, mortgages, and a whole host of other financial services and advice. They're quite simple and we won't go into any more detail, so let's move on to commercial banks. These provide similar services but to businesses instead. So again, they provide current accounts, saving accounts, and other types of bank accounts. They also provide loans and other forms of credit such as trade and asset finance, and they help facilitate payments and transactions. They may provide other services such as risk management too, which includes foreign exchange, interest rate risk, and inflation, and occasionally they'll provide wealth management services for private clients. The third type of bank, and the subject of this video, is investment banks. They're comprised of a number of subdivisions which vary depending on the bank in question, but there are three typical subdivisions: the investment banking division, sales and trading, and investment research. The first one is the investment banking division, and that is divided into two, and that is M&A, or mergers and acquisitions, which facilitates the buying, selling, and merging of businesses. And then you have capital markets, which helps businesses raise capital, both debt and equity, to finance things like acquisitions, projects, and dividends. The second subdivision is sales and trading, and this helps facilitate the buying and selling of assets such as equities, bonds, and real estate on behalf of institutional investors. So these are typically asset managers such as BlackRock, Vanguard, and Fidelity, as well as hedge funds. The third division is investment research, which provides analysis and insight on companies, sectors, and their economy on the whole. This is both used by the investment bank itself and sold to clients to help inform their investment decisions. All of these divisions are considered front office roles, and these are client-facing, revenue-generating, and typically the part of investment banks that most people try and get into. But that does not mean they're the best, and they're ably supported by middle office roles such as credit and market risk and compliance, which essentially act as a check and balance and make sure the front office guys don't do anything silly. You then have back office roles, which are more admin and operationally focused, and this includes things like financial reporting, data, technology, and so on. So coming back to what I do, and that is leverage finance. So as I mentioned at the start of the video, I help private equity firms and corporations raise capital to help finance their acquisitions. And it is called leverage finance because a large percentage of the purchase price paid for the company is funded via debt, which makes it considerably more risky, and therefore extensive evaluation and analysis is required. So why do we agree to them, and why do the private equity sponsors use them? Well, it's to magnify returns. And to bring that to life, let's consider a simple example. Say you're looking to buy a house for £100. It's not in the best neighborhood, but you see potential. And we'll consider two funding scenarios. So in scenario A, you will finance the entire £100 using all cash, i.e. all equity. Now let's fast forward 1 year. The property is worth £110 and you choose to sell. Your initial £100 investment has become £110, and so you made £10, which equates to 10%. Simple, right? Now consider scenario B. So the house is again worth 100. Say on day one, you choose to only put £10 of your own money in and borrow 90 from the bank, i.e. you took out a mortgage. Now let's fast forward 1 year again, and the property is worth 110 and you choose to sell. Well, you return £90 to the bank, and for simplicity we'll exclude interest and fees, and you keep the remaining 20. That means your initial £10 investment became £20, i.e. you still made a £10 return, but now that is a 100% return. So the returns have been magnified, and that is the power of leverage. Now it's important to note, the inverse applies too. Say the property is now worth £90 instead of 110 at the end of the first year. You choose to sell again. In scenario A, where it was entirely cash funded, your £100 is now £90, meaning you made a £10 loss, which equates to a 10% loss. But in scenario B, you still have to return £90 to the bank when you sell for £90, meaning you're left with nothing, and your initial £10 has become zero. Therefore, you made a 100% loss. So leverage magnifies returns, whether positive or negative, and that's where the risk comes in. So why do investors fund this? Well, it's a very lucrative business. Because of the risk, they charge high fees and high margins, but a lot of analysis is required to get comfortable with this, and that's what I do. So I wake up around 6 a.m. every day, pop the coffee machine on, and try and get active. So if I'm working from the office, then I'll do a mobility routine at home just to get the blood flowing. And if I'm working from home, I'll hit the gym so I can get that under my belt before I crack on with the day. Then I'll come back and I'll flick through news outlets such as the Financial Times and Bloomberg, read market updates and economic reports, consider any internal comms, and I'll look out for specific information on current or potential investments. Previously, I was also studying for the CFA Charter, which I completed this year, so I would normally study for that in the morning too. So we'll kick off the day at 9 a.m. with a whip call or a work in progress call where we discuss live deals and prospective opportunities, market developments, and generally get each other up to speed on how things are progressing. There is usually a director, associate director, an associate, and potentially a graduate on each deal, and depending on who's present, I may be required to give an update on the deal. Beyond this, my day can vary quite a lot, but I'll give you a general overview of what a typical day looks like. So in the morning, I'll often be attending management presentations with the CEO or the CFO of companies we're considering investing in, and this can be virtual or in person. And I may also attend diligence debriefs with consultants who have done a deep dive into a specific business or sector, so we often lean on their expertise to help inform our decisions. If I have any client meetings, I'll attend those, and I'll also make time for coffee chats with colleagues, contacts in the market, and also prospective graduates who are interested in joining our team, given leverage finance is an interesting place to work. Between 12 and 1, I'll try and get off the desk and get a walk in, especially now that it's summer, and I use a standing desk both in the office and at home, which keeps the blood flowing and helps me keep a slightly better posture than I would have if I sat down all the time. So moving into the afternoon, and this is where I do the research and analysis. That includes evaluating the business model, considering the market and competition, and conducting financial analysis, building financial models, and modeling various future scenarios and seeing how that impacts our risk and returns. I'll then translate this into an investment memo, which is essentially a report that we present to our investment committee. And I'll also put together pitch decks where we highlight our financing thoughts and essentially pitch to be on the deal and put our best foot forward. Later in the afternoon, I'll attend an investment committee where we discuss research findings and we debate the pros and cons of doing a specific deal alongside key stakeholders such as our credit colleagues and our coverage colleagues who are the relationship management people, and ultimately I'll contribute to the decision-making process. So moving into the evening, i.e. beyond 5 p.m, and this is typically where the legal discussions take place. Alongside the business and financial analysis, we also have to do a lot of legal work, and this relates to the documents that govern the deal and dictate what the lender and specifically the borrower can and can't do. And this is key because a lot of money is going into this transaction, often in the multi-millions, sometimes into the billions across multiple lenders. So it's really important that the documents are well negotiated and watertight to protect us and the borrower from negative outcomes. Lawyers love working late, so this often spills well into the evening, and it's a very fast-paced and complex discussion, and as an associate, it's my job to try and learn as quickly as I can, although contributing to this stage of the deal is quite difficult. I'll also use this time to wrap up any outstanding tasks which were difficult to do during a busy day, and I will target finishing by around 9 p.m. if I can, because my productivity falls off after this, although if I can't, I'll have to continue on beyond that, but if I can, I will defer out to first thing in the morning and tackle things with a fresh mind. But generally speaking, in this space, you don't have full control over your diary. Things can go in at any given time, and generally you have to be very flexible. At the end of the day, I'll take stock and outline my priorities for the next day, and then try and spend 1 or 2 hours on something else that I enjoy, such as my side projects, or reading, or spending time with my wife and watching some TV. I'll then enter my sleep routine, which involves a few different supplements, a stretch, and a massage gun, which I'll outline in a different video, but generally that helps me get a high quality sleep, which is key to operating at a high level. So that concludes this video. Hopefully that's been helpful in terms of understanding what investment banking entails. It's definitely fast-paced, dynamic, and quite high pressure. However, it's fulfilling. I enjoy it. You get to analyze companies, speak to clients, and you're involved in strategic decision making. If you enjoyed this video, hit the like button and hit subscribe for more content like this. And otherwise, thanks for watching and see you in the next video.